Good afternoon, everyone. It's Tim on the buzz with you. I'm with you all the way to 3 p.m. And today is Thursday. So Thursday means we've got Chris on the show coming on, giving us financial advice. He's giving us, tips on how to increase our net worth. Today we've got a cool topic. Now we know Elon Musk, Jeff Bezos have been a couple of, taking up the news by storm these days, right? But one thing that people need to clarify is how their net worth is collected or calculated, because when it comes to this, people think, well, if we say that Jeff Bezos has $140 billion net worth, people think that that's how much he has in the bank. But now we've got Chris here from CS Jones, ready to brief us down on how this net worth is calculated. Hi, Chris.
Hey, Tim.
Good to see you after a while. We'll have you now break down how to calculate the net worth of these individuals. If it is us as people as well, it's all the same calculation, right? It's the same equation. So what have you got to say? We'll break it down from there, from basics, and then just get an idea of how you're planning on calculating if it is assets, if it is liabilities, so on and so forth. The stage is yours.
Thanks. Yeah, I mean, you're absolutely right. Your worth isn't how much you've got in your bank account. And I think if Jeff Bezos woke up and saw 140 billion pounds in his bank account, he'd have a heart attack because that's not worth anything. We went through money last week and we saw that it's not an asset, right? It decreases, so you don't want it in money. We can get quite complicated, but let's put one thing here is math is important, and this is where it becomes important. So, if you didn't learn math at school, you need to just learn the basics, because 1 + 1 definitely equals 2. And how we work out someone's net worth equals assets minus liabilities. That's it. That's the accounting equation. That's what companies use. It's what individuals use. It's what accountants use. Everyone, and that's how we get to it. So your assets, your assets go from everything from cash through to company stock that you own, and your liabilities go through everything from credit card debt all the way to loans that may be outstanding or creditors chasing you for different things. How we get those? Sorry, yeah.
How are we looking at breaking down the conversation today? So we've got an hour with you. I don't want to waste any time, and just to get an idea of how you're looking at breaking it down for us, explaining to us if it is breaking assets down, breaking liabilities down. Or last week we had a cool conversation with the history of currency and how we got there. So it was not just that; it was from the beginning of time, and how America and the gold story. That was super interesting. So if you've got anything lined up like that for a conversation, we can break it down. And so if we can break that down before I put us into a couple of videos to show our audience who Relaks Radio is.
Sure. Let's break it down. Let's define an asset and see how we can accumulate them, because you want more assets than liabilities. Let's define a liability. There's good and bad liabilities and how we break those down. And then let's see how we can get that equation in such a way that we can make ordinary people, not just billionaires, wealthier, right? Well, what are the tips? Let's close it off on that, I think.
Absolutely. So this is the buzz, everyone. If you are keen on understanding what more or how you actually break your net worth down, how anyone's net worth is broken down, how a company is evaluated, how individuals are evaluated, we've got Chris here from CS Jones, as usual on Tuesdays, 12 to 1 p.m. Breaking down everything finance. And if you want to basically brighten up touch up on your finance knowledge or IQ, you need to be here on the buzz. Feel free to call us up on 07852473473. You can also call, you can comment on this video, you can like, share, subscribe to our YouTube channel so you don't miss any of our videos as well. But before we get into the conversation, I'm going to show you a quick couple of videos of who we are at Relaks Radio. Stay tuned. That's right. We have Relaks Radio. We're on Twitter, Instagram, Facebook, YouTube. Making it easy for you to actually tune in to whatever channels you are familiar with, whichever channel you're actually comfortable with. And you can also check us out on the App Store and the Play Store. We are at Relaks Radio right there as well. You can call us up on 07852 473 473. But coming back into the conversation with Chris now. Chris, stage is yours. Like I said, we'll go on into understanding how you actually break the equation down and understand our net worth or even a company's net worth.
Thanks, Tim. Let's start with liabilities because they generally the easier to understand. Then we'll go into assets because there's quite a few definitions of assets depending on where you're coming from. But we'll come from a financial wealth or a total wealth perspective. So liability is simply anything that detracts from your wealth, that takes away. Meaning, let's take it from a cash flow perspective. It can be a debt or a mortgage or any other loan, such as a credit card or hire purchase loan, that takes away from your cash flow. And why is that important? Why is that seen as a liability? Well, because that cash that you're paying for that liability, you can't invest it. So you can't put it elsewhere to grow. So there's an opportunity, what we call an opportunity cost. And those fall into varying categories. So what I like to say to people is if you want to increase, one of the easiest ways to increase your net worth is to ensure that you have higher cash flow. And one of the easiest ways to do that is to not buy things on hire purchase, not buy things over months and months because you can't afford them now, but you want it. It's kind of that delayed gratification. Rather than buy that couch, that car, that stereo, that computer, whatever item, and pay it off over 12, 24, 36 months at an interest rate, rather invest that money, make do with what you've got, and then after 12, 24, 36 months, take the money that you've now invested and buy that good. It's a simple process. It's difficult for people to master because it's an emotional choice. However, all the billionaires, all the multi-millionaires, all the rich people, they've made those choices earlier on. Yes, they don't have to make them now, but they made those emotional choices earlier on. So don't spend what you don't have, basically. Keep your liabilities low. I understand in the case of a mortgage that it could be slightly different, which is fine. But then you go within affordability limits, right? Because people must understand the cost of a mortgage, and it's a high cost item over a long period of time. So you need to understand that basis. So liabilities, pretty straightforward. You can go into that. Assets, on the other hand, are varying and can differ according to what you want them to do. In a company, an asset could be anything that appreciates or reduces a tax bill. So it could still be a liability, but it reduces their tax bill. And I'm not going to go into the technicalities because that's out of our remit here. However, for our use or our purpose, what we are talking for the listeners here is I would put this definition of an asset forward. An asset is anything that increases your income. Anything. So that throws a couple of spanners in the works. And here's a clear example. A person buys a property. They buy a property as an investment, so they're not going to live in it. It's a buy-to-let. They're going to rent it out. However, they don't have enough deposit. They don't put a big deposit down. They get quite a big mortgage, and they rent it out for less than what they're paying for in the mortgage. So if you work out the tally, they're actually losing money on it, right? And they're having money in. And they say to me, but it's an asset. Well, no, it's not. Because you're relying on the capital value of that property to go up for it to be an asset, but it's decreasing your cash flow. It's not very smart, right? So that buy-to-let property is not a asset. If you do a buy-to-let property and it makes you money after repairs, after servicing, after agent fees, after all the maintenance costs and other bits and bobs, then yes, it's an asset. It increases your value. So that's quite a good example. A car is not an asset, although you will still count it into your net worth as an asset because it adds to the value of your total net worth, but it'll be decreasing all the time because a car's value decreases over time. But if you buy a car for cash, then it's not detracting from your cash flow. But if you buy a car on HP, then it is detracting from your cash flow. So you'll have, and here's where the accounting bit comes in, or the math bit. On the left-hand side, you'll have the value of the car, and on the right-hand side, you'll have the payment coming out. So it'll offset each other on that basis.
Now, to stop you there for a second, Chris, what I want to clarify there is, would you wouldn't always now say, since we are talking about a car, we wouldn't always consider a car as an asset. Right now, if it is, unless it is used to make money, now if it is, for, I'd say, something in the lines of an accounting firm, if this was purchased for an accounting firm where people don't always have to, where the staff don't always have to, visit the other officers, things that you understand how things are done. But in the case of, if it is a cab company, if it is a transport agency, this is used for cash flow, right? So if it is for tours, or if it is for, basically taking people around and they earn from that, how is it considered an asset? Does it have to show a certain amount of return? Does it have to show a certain amount of yield on, after the purchase?
It's a good question, right? And I think that goes to all assets, whether it's a car or a property or stocks and shares, or anything. What we would call the yield or the rate of return on that asset is important, right? Because again, it goes to that saying I said, which was opportunity cost. Because if I put my money, as an example, if I can put my money into a transport vehicle of some sort, either transporting people or goods, and I can get, let's say, a rate of return of 10%. I'm just making these figures up, by the way. I don't know. I'm just saying 10%. Or I can put that money into a stock that pays a dividend. Now, it's very important that if you're going to compare assets, that you don't look at what we would call the capital appreciation, because that's what happens in the future. I don't know if a share is going to increase in value, or a house is going to increase in value, or anything is going to increase in value or decrease in value in the future. No one knows, right? We just don't know. But what we do know, and what we can kind of gauge, is if I had this, let's call it a truck or a bus, and I transport so many goods, I'm going to earn this much money, which will give me X percentage. In our example, a 10% return on my value. Or I invest in this share, and this share is going to pay a dividend, which is different to the capital growth of X, which is only 8% per share. Then I'm better off going into the transport of the bus side, right? Or vice versa. But most people don't do these calculations, and these calculations can be quite tricky. And to compare it equally is almost impossible. So what do? It starts to unravel quite quickly. Most of my career in stockbroking was spent doing the math necessary to try and value companies and assets. And there's 100 ways to value the same asset and get a different price and a different return on it every single time, depending on what you do. So let's make it quite easy. If you have limited capital to invest, then generally the best way to invest is as tax efficiently as possible, so that you're not paying tax, which is lowering your costs, which automatically increases your returns. And for normal people like me, what we do is I'm an investment professional, but I do not invest in single stocks and shares myself because I just don't have, well, A, I don't have the time, and B, I don't have the facilities here on my own to do it correctly. So I use unit trusts and various pooled investments where there are managers looking after it all the time. So, which is quite important, right? And if we've got limited capital, those are the best ones to go into, and you go into tax efficient investments.
Now,
As you have, sorry, yeah, carry on.
Yeah, when you say you don't have the time to invest in stocks, okay, now let's say me, for example, if I was looking at investing in stocks, and I understand if when you're doing a full-time job or even two jobs, you don't have all the time to keep analyzing the market or stay in front of a couple of screens, so on and so forth. You might work with a broker, you might understand where you have to, you might get tips obviously on where to invest in, but at the end of the day, it's your decision, right? Or it's up to you to consistently analyze. So what do you say to people, that have to, so say someone like me, if I have the budget to, allocate at least, let's say, 10 to even 50 pounds a week to allocate on my investments, what strategy would you suggest there? Because that obviously, I mean, in the lines of a positive hope, where this only compounds to to increase, right? So, what type of strategy would you recommend for that operation?
Depends on the person. If you've got such a small budget like that, and I'm not demeaning anyone's money, but in the world of investing, £50 a week is below a lot of minimums because the kind of licensing that we go through and all of the onboarding that we have to do for an investment, the costs generally outweigh a small amount like that.
So, what number would you suggest? What type of, how much would you reckon allocating for investments on a weekly basis?
Look, I mean, it's up to you. You've got to work it out, right? So what I would suggest is this. If anyone wants to look at investing and saving, it doesn't matter the amount. Any amount is good. Let's just make that quite clear, right? Secondly, you need to start with the end in mind. So say, okay, what am I saving or investing for? Why am I doing it? When will I need the money? And how much money do I need? Yeah. So that's quite important because when you're looking at your net worth, you got to start and say, well, what do I want my net worth to be so that there's a goal? And then work backwards. How do I get there? And if I can start with £50 or $50 a week, if I save that every week, and you can go online and use calculators online. I don't have to teach you the maths behind it, but you can say, okay, and if I get a 3% return and I put this away for how long will it take to reach my goal? And that's called it's basic cash flow projection calculations. And it's what we use in financial planning all the time. What we say to clients is we say, okay, what is your goal? What is your objective? Where do you want to go to? And we discuss that in a lot of detail and over most of the meeting. And then the rest of it is saying, okay, in your exact circumstances, with your risk profile, with how you feel about investments and pensions and taxes and where you are and who you work with and, your education level or your lack of education or how involved you want to be. There's a lot of variables that we take into account. And then we say, okay, here's a plan. You start like this, that's great. And then we review it all the time. And we say, okay, we need to increase it. We're on track. We're not. This is what has happened. Because remember, when you're dealing with assets, the valuations that you place on an asset are always behind you. It's always in hindsight. It's never in front of you. And that's one of the challenges, right? Because you're always valuing what happened yesterday, and what you need is what's going to happen tomorrow. So that's a struggle. Yeah. So there are strategies everywhere from £50 a week up to £100 million pounds, and they're different, right? They range differently from everyone, but and from country to country, to be fair. Different countries have different tax laws, so with different vehicles. But from your point of view, at the sort of normal end, I'm not going to call it the low end because I'm in that boat as well. It's as tax efficient as you can get it. That's where you start. You use all the tax efficiencies, and then you step up into different things.
Okay, right. So when it comes to further now calculations, or now we have this, at least in the UK, right? If we are, now there's a lot of conversation around who pays more taxes, if it is the rich or if it is the poor, right? I think this is an important topic. I think we can basically break down to, basically address this, let's say, conversation, and basically explain why they say this. Now, when you are when you are basically going out during a day, if you go to a restaurant, you have to pay taxes there. If you buy a car, you have to pay taxes there. So apart from that, on your residence or wherever you are, you need to pay a certain amount of tax. But when it comes to, let's say, the high net worth individuals, or if it is companies, how is that? How do they actually, why is the conversation even a part of? Why is it even a conversation that the rich pay less taxes or the poor pay more taxes? Why is it a conversation like that?
Because it's true. The rich generally pay less tax. And there's a couple of reasons for that. Because if you look at the overall, not, and this doesn't pertain to anyone, I'm generalizing here. And let me just caveat all of this by saying I'm not a tax expert either. However, the properties of a high net worth or generally, rich person is that they have their own business, generally an entrepreneur, or they've invented something. They're on their own. They are their own bosses, and they generally have greater control over their lives, right? Where the general properties of a middle class to lower income person is they work for someone else. They're generally on a PAYE system, getting paid a salary, and they don't have much control over the income they get paid or how they get paid it. And that makes the distinction on the rich paying less tax. A rich person walks into a Tesco's or a Sainsbury's, they're not going to get a different bill than another person, right? They're still going to pay the same VAT on those goods. They're still going to pay the same thing. So that's all the same. However, the differences come in if you can pay yourself from your own company, you can structure it in a way that you pay less income tax through paying a bit of salary, paying dividends, and so forth, and then also deferring income. Also, your pension payments or contributions can be different. So that increases your tax sort of gap, if you want to use it that way. Where a PAYE person just gets paid salary and bonus. And now those are the most highly taxed sources of income in the UK, definitely, in the UK. Also, you think of a wealthy person or wealthy entrepreneur, most of their wealth is tied up as an asset, which they can't really access, but in their company, right? In the value of their company. So what happens when they come to retire? They sell their company. And now selling a company that you own is very, very, very tax efficient, because now you take all that income out and you pay a lot less tax. If you get entrepreneur's relief, it's 10% tax. So as an example, if you sold your company for £10 million and you paid 10% tax versus earning £10 million as a salary, you'd pay 45% tax. So that just a quick example there is quite telling. So the middle class to lower incomes pay more tax than the rich because they don't have the options of being able to pay their income in varying ways. They also miss out on quite a few other opportunities in the investment world, such as, we talk about VCTs and EISs, which are tax-structured investments, which give you up to 50% tax breaks on these investments, but you need wealth to do it in those. And that, they give people the options to generate intergenerational wealth in a very tax-efficient way.
Now, yeah. So for that conversation, basically, I think there's another breakdown in terms of, let's say, how these guys. Like when I say that, I mean people like Jeff Bezos, for instance. Now, every time he sells about $3 billion worth of stock in Amazon, or just how Elon Musk sold the whole of PayPal, and he basically wanted to move in the lines of SpaceX and then Tesla. He put all that money into SpaceX and Tesla, but it's also I've also heard stories of how even though he did that, he had about $60 million, if I'm not mistaken, when he started off, but 60 or $600 million. But then he basically invested all the money, and he eventually stayed on rent, or he borrowed some money for rent by some friends or from some friends, and he actually started off with those companies. Now, when we talk about stocks, we understand that people, I think, firstly need to understand, okay, if the value of a stock of Amazon is $1,000 or something, and then if the value of Apple is about, let's say, 500, people tend to think that Apple is less valuable as a company than Amazon. But whereas you see the bigger picture, if you actually look at the net worth of the company, it's the other way around, right? But now, yeah. So, do you think you can break that down? How share values change with the number of shares in a company, and then how, when it comes to the owner, how much do they actually own in it when it goes public? Things like that. Do you think you can break that down for us? We can actually get down into a couple of videos to show our audience who we are at Relaks Radio, and then we can get back into that. Yeah.
We do. Yeah.
So everyone, just feel free to comment on this video if you're watching. Just like, subscribe, share this video, and hit the bell icon on our YouTube channel so you don't miss any of our lives or our videos. You can also, remember to call us up on 07852473473. We've got Chris here all the way to 1 p.m. He's breaking down how billionaires, or if it comes to companies, how the equation is actually broken down, and you need to understand how basically these calculations are done, so you can use it later on in your life, regardless of where you are. There's no such deadline to learning, right? So what we'll do is we'll show our audience a couple of videos of who we are at Relaks Radio, and we'll be right back. Welcome back, everyone. This is Tim on the buzz. I'm with Chris here, talking about breaking down how your net worth is calculated, how you as an individual or a company have your net worth calculated, what the equation actually means. If you are reducing your liabilities from your assets, and then coming to a point where you need to understand the differences between the value of a stock versus the value of the company. So Chris is here. He's going to break down, the conversation between the value of a stock and a company, because what people tend to underestimate, or tend to, take it different ways. When the value of a stock is lesser than another company, it doesn't mean that the value of the company is less than the other. So Chris, if you can, basically break that down for us, explain that to us, and then we can go also to talk about, when it comes to the owner, the founder, how much of an average do they actually earn in a public company? And then when it goes public, do they actually give all the shares out to public? How do these work?
Yeah, so good questions, right? First off, the value of a stock is very rarely actually even correlated to the actual value of a company. Because in a public company where the stock is traded openly on a stock exchange, the value of that stock is driven by supply and demand, it's driven by emotion, it's driven by news, it's driven by quite a lot of variables over and above the actual accounting or total net worth of that company. We've seen it, right? If an owner of a large public traded company does something wrong, irrelevant of what that company does or how valuable that company is, the stock generally falls into a pool of nothing, right? And the company may still have value and may still be doing quite a good thing. So, never equate the value of a stock to the actual value of a company. It can show that if a stock is falling, the price of a stock is falling, that there is something wrong with the company. We've seen Enron, we've seen all sorts of things like that. But yeah, it's kind of judging a book by its cover sort of thing. When a company lists, that's called an IPO, or an initial public offering. And how that works is the company owners sit down with a investment bank, and an investment bank puts together the offering, and it's called an initial public offering because the investment bank will put the value of the company and have a per share value, and then it's generally about 20%. It's never really less than 20% of the company. Sometimes it can be more, and they will offer that stock to mainly institutional traders in order to judge a couple of things. Have they got the value of that stock right? If institutional traders buy it, then generally they have. It's called oversubscribed. If they oversubscribe the listing, then it's seen as more valuable than what the bankers have valued it at. And if it's undersubscribed, i.e. they don't really want the stock, then it's generally overvalued. And that just shows that the math that we employ is just a method. It doesn't mean that it's infallible. It's just a method. And then those institutional traders will agree to buy blocks of stock and get allocated that stock as the stock lists. So on the first day. And that's why you get large price fluctuations of stocks when they list on their first day, sometimes even their first week, because you'll have a lot of profit taking. So the owners of the company will agree to sell a percentage of their stock for the listing. Now, they will change the share issue accordingly. And let's say, for an example, the company lists that they're going to issue 10 million shares. So those are 10 million shares, and let's say it's $1 a share, just to make the math easy. So the company is valued at $10 million, right? and it's oversubscribed. So the actual value of the company is closer to $12 million. So what will happen is the shares will trade and they will go up to $1.20, right, to reflect. And that's what we say is the free market. That's what should happen. It never does because people will get excited and they'll keep buying. And the value of the company is $12 million, but the share goes to $1.50, right? So it's actually valued the company at $15 million. But then people will start to profit take and say, oh, I've got profit and it's overvalued, and so I'm going to sell. So now they start selling the share and it'll come all the way back down to $1 a share. Right? So
it's a love-hate relationship with the stock market. I mean, any stock, for instance, I think owning crypto, for instance, now it's like that what you just explained is just magnified to a massive extent. That emotion it's pretty much on steroids when it comes to crypto. So when it comes to investing like that, now when you talk about the initial public offering, there have been second public offerings, so on and so forth. How are these done? Do they offer more of the company, or and also how much of the company do they eventually offer? What is the most that we've got on, at least in history? How much has a company offered to the public?
I wouldn't know, but as an example, the founders of Apple, although Steve Jobs is gone, had very few shares. I think this is before Steve Jobs got fired and came back, of course, but he didn't own a controlling share. They didn't do that. Bill Gates didn't have a controlling share when they listed. Listing's interesting because it's not suitable for everyone. When you list a company, you, in the eye of the regulator, you are no longer a private company, you're a public company. So people can access your books, they can access shareholding, they can access the percentages, they can access what you're getting paid out of it, the dividends, all those kind of things. So it's a different environment. One of the biggest listers and then delisting again, of course, was Virgin with Richard Branson. He listed Virgin and then he delisted Virgin again into a private company, which is a costly thing to do. However, it just didn't suit their business model. It's not wrong or right. It's just the way it is. I think, and I could be mistaken, one of the largest private companies that still isn't listed today is Lego. They're still a privately owned family company, which says a lot, right? So that's interesting.
I didn't know that about Lego, honestly.
Yeah, it's still private. And a lot of companies list so that they can raise capital to expand. That's one of the main reasons. Another way of listing is remember when we were talking about funding companies and your startup costs and things like that? If you did venture capital or private equity, part of your agreement may be that you have an exit strategy of listing. And then the owner, let's say I'm the owner, I don't actually offer any of my shares, but the private equity or the venture capitalist offers their shares and it's their way of exiting. So that could also be another reason. So there's various reasons for that. And nowadays you have alternate options to listing. I mean, back when I was a stockbroker, we just had the main board. Now you have the AIM board, which is for lower valuations. And of course, these group funding pages, it's almost a public listing in itself. While you're not actually trading equity, you're still trading value in the company, right? So that's also an alternative, which is all interesting stuff.
So we seem to have just a couple of minutes more for the show with you, Chris. But before we head out now, in terms of someone that is looking to again increase their net worth, let's say for the majority listeners, how would you reckon? What first 3 steps would you take to moving in a path where you keep increasing your net worth? Maybe first of all on an investment basis. Second, it can be also on a debt reduction basis. What what steps would you actually, basically advise to me, for instance, if I was looking to, let's say, double or quadruple my net worth in the next couple of years?
Look, don't accumulate debt. That's rule number one. Sometimes it's unavoidable, and so if you do, then try and reduce it. Secondly, always look to control your income as much as possible, and generally that comes from owning your own company, or contracting out, or being self-employed, or those kind of things. And it's the harder road to take initially, but over the longer term, it is the only way to create long-term sustainable wealth. And it's proven. There's very few employees that get really rich, And thirdly, don't be rash. Don't make rash decisions. There's always another time. Don't chase the buck, right? I would never invest in single shares or Bitcoin. It's just not. It's not the way to create long-term wealth. You do long-term sustainable investments. You invest in one share, my God, tell you the stress would kill me, because it's going to go up and down. It doesn't matter what it is, right? It's going to go up and down all the time.
Never put all your eggs in one basket.
Well, exactly. We diversify, right? And use professionals to help you with your money. So whether that's like myself, a financial advisor, all the way through to investment managers who do this for a living. People say, oh, but I can invest in it. I say, okay, do you have a Bloomberg terminal in front of you? Because I know they don't. Because A, they cost 20 grand a month just to rent these things. And B, you need multiple degrees to read them. So, it's, they're there for a reason. So the guys are clever. And then financial advisors like myself, we can do tax efficient. We plan you, and then we make sure that you have the right investment managers for your risk to manage everything correctly. And it's slowly. And it becomes quick because of compounding. Don't try and make it in a year. Try and make it in 15. That's a good plan.
I'll take it from you, Chris. Can't trust you for that, because I'm pretty sure I'll be saving money down the line if I actually invest in advice from someone like you for financial advice. Thanks, Chris, thanks for joining the show today. Appreciate your knowledge and the information, the advice as well. We'll catch you on next week on the buzz from 12 to 1 p.m. on Thursday.
Good man. Thanks, Tim. Have a good one.
Thank you.